welcome to the deep dive. We hear a lot about big investors and the sheer amount of money they control. But how does that actually translate into influence? How do the people who own a slice of a company really get a say in how it's run?
That's the core question we're tackling today. We're going to dive into the world of shareholder engagement. This is basically the process where investors try to communicate with companies to influence things like, well, strategy, governance.
And those ESG factors too, right? Environmental, social, governance.
Exactly. Those are increasingly important. It's about influencing all of that.
Right. So it's not just about buying low and selling high anymore. It's more like a relationship. And we're going to figure out what that relationship actually looks like, what tools investors use, who the major players are.
And crucially, we need to peel back the layers on that big debate. Does any of this engagement actually work? Does it make a difference?
Okay, let's unpack this. How does it usually start?
Well, think of it like a ladder, maybe, or an escalation framework. Investors don't usually start by, yelling from the rooftops. It tends to be a structured approach.
Starting softly and getting tougher if needed.
Precisely. Moving from softer tactics to much more forceful ones.
Okay, so what's the first step? The bottom rung.
That's all about persuasion. This is quiet dialogue. We're talking regular calls, meetings, investors just sharing their expectations on key issues.
Kind of behind the scenes.
Yeah, mostly. For companies with debt, it might involve bringing things up during bond sales or, in loan documents. It's really about building that initial relationship and trying to persuade them.
And if that doesn't get traction?
Then you move up to step 2, challenge. Now the investor might start speaking out more publicly.
Like at the big annual shareholder meeting.
Exactly. Or maybe challenging management during an earnings call. They could even team up with other investors, co-file shareholder resolutions.
And for debt holders, how does that work?
For them, it could mean challenging specific actions or maybe a lack of action related to the terms of their bonds, using the leverage they have.
Okay, step 3. Getting more serious.
Definitely. Intensified dialogue and voting. This means pushing for those higher-level meetings, not just with investor relations, but with senior management, maybe even the board members themselves.
And using their vote more strategically.
Absolutely. Voting against management proposals, voting against directors they don't think are doing a good job, and trying to rally other investors to their side. Debt holders might start invoking specific contract clauses called covenants to press their point.
Okay, this sounds like it's heating up. What's step 4?
Now we're at exceptional escalation or capital allocation decisions. This is where investors might file their own shareholder resolutions, not just signing on to someone else's.
Going it alone, basically.
Or even launching a proxy contest, trying to actually replace directors on the board with their own candidate.
Wow, okay. And on the debt side?
For debt holders, this is where they might say, look, we're not buying your next round of bonds, or they might start actively selling the bonds they already hold if they're really unhappy, using their capital allocation power.
And the final step, the nuclear option.
That's step 5, the levers of last resort. This is the ultimate statement, really. Full divestment.
Just selling all their shares?
Yep, selling their equity stake completely. For bondholders, it's selling those bonds on the open market. It's basically hitting the exit button.
So the idea is that the power to influence increases as you climb these steps.
That's the theory, yes. The potential to drive change generally increases. And this framework, it applies whether the investor holds stock equity or whether they hold the company's debt. Different tools, same goal of applying pressure.
Makes sense. So who are these investors doing the engaging? And it's not just one monolithic group, is it?
Not at all. We really need to distinguish between 3 main types of investment managers involved here. Passive managers, active managers, and activist hedge funds. And they operate quite differently.
How so? What are the key differences?
Let's look at a few characteristics. First, think about how many companies they own. Passive managers, the ones tracking indexes like the S1E 500, might hold shares in hundreds, even thousands of companies.
Okay. And active managers?
Active managers who are picking specific stocks they think will outperform might hold maybe hundreds, fewer than passive generally.
And the activists?
Activist hedge funds. They're usually highly concentrated, focusing on a small number, often fewer than 20 companies at any one time.
And can they all engage? Do they all have a voice?
Yes, technically all three can engage with companies. They all have that potential voice, but their ability to simply sell their shares, to use the exit strategy, that's a key difference.
How does that break down?
Well, passive managers generally can't just decide to sell a stock because they don't like the management. They're usually bound to hold whatever's in the index they track.
So exit isn't really an option for them.
Not easily, no. But active managers and activist hedge funds, absolutely. They have the freedom to trade in and out of stocks whenever they want. Exit is a very real tool for them.
What about their intention? Why are they investing in the first place?
That differs too. Standard passive and active managers aren't usually buying stocks specifically with the intention of forcing big changes in how the company operates. Their main goal is usually financial return through market movements or stock selection.
But activist hedge funds?
That's precisely why they invest. Their whole model is often based on identifying companies they think need changing and then pushing for those changes to unlock value. Changing the company is the intention.
You can even see it in how they get paid, right?
You definitely can.
Right.
Passive managers usually get paid a small, fixed percentage of basis points on the total assets they manage. Very low fees.
Active managers.
Their pay is typically more variable. It's often tied to how well their fund performs compared to a benchmark index, so performance matters directly.
And the activist hedge funds have that famous model.
The 2 and 20? Often. A 2% management fee on the assets, plus 20% of the profits they generate from their investments. So their incentives are very strongly aligned with making profitable changes happen.
And what about the resources they put into this, the actual people doing the engagement work?
Vastly different. If you looked around, say, 2019, a typical governance team member at a big passive manager might be responsible for covering something like 250 companies in a year.
Wow, it's a lot.
It is. At an active manager, that number might be closer to 20 companies per person. Much more focused.
And the activists.
Maybe just one company per team member. It really highlights the depth of focus and resources an activist commits compared to the others.
It gets a bit confusing, though, because sometimes you hear both active and passive managers who engage being called active owners.
That's true. The terminology can be tricky. But it's really important to remember that fundamental difference. The ability to freely trade, to exit, is what sets a standard active manager apart from a passive one, even if both are engaging.
Okay, let's zoom in on those passive managers then, especially the really big ones. We have to talk about the big three, right?
Absolutely. Vanguard, BlackRock, and State Street Global Advisors, or SSGA. Their sheer size in the market is just enormous. They hold such huge chunks of major companies.
How big are we talking?
Well, data from late 2019 for the S&P 500, that's the index of 500 large U.S. companies, showed Vanguard owned about 8.2%, BlackRock had 6.6%, and SSGA held 4.4%.
So together, just those three held nearly 20% of the entire index.
Almost 1/5, yeah. And if you looked at the top 10 largest shareholders combined, they held almost a third of the S&P 500 back then.
That's incredible concentration.
It really is. And in some sectors, like real estate or utilities, the concentration was even higher. The top 10 shareholders held over half the sector. This is largely a result of that massive structural shift we've seen since around 2007.
Money pouring into passive index funds and ETFs.
Exactly. Huge inflows into passive, while actively managed funds, on balance, saw outflows over that period.
So these big three are massive owners. But do they all act the same way when it comes to engagement?
Not entirely. Even though they're often grouped together, their approaches do differ. They have different philosophies on things like how much they should defer to the company's board of directors.
What issues they consider material or financially important.
Right. Including whether they focus just on how ESG issues impact the company's bottom line single materiality, or also consider the company's impact on the world double materiality. And they also have to navigate the fact that their own clients have diverse views on sensitive topics like climate change or diversity initiatives.
Okay, let's break them down a bit. What's Vanguard's approach generally like?
Vanguard tends to structure its engagement around 4 main pillars. They focus on board composition and effectiveness, how the board oversees strategy and risk, executive compensation, and shareholder rights.
And how do environmental and social issues fit in?
They generally view E&S topics through that governance lens. The key for them is ensuring the board has effective oversight of the related risks and strategies. Their philosophy often emphasizes delegation to the board if they believe the board is well composed and functioning effectively.
Do we have examples of this?
Yeah, their reports from early 2024 mentioned dialogues with companies like NGSA in Europe about shareholder rights, or SPA, the energy company, about board oversight of risks. They frame these conversations as ways to share perspectives on good governance to support long-term value creation.
Okay. What about SSGA, State Street?
SSGA organizes its approach around three core principles: effective board oversight, good corporate disclosure, and protecting shareholder rights. Similar themes, slightly different structure.
Have they been changing their approach?
They have been responding to client demand. For instance, they launched a specific sustainability engagement and voting service in May 2025 for clients who really want that focus. And they've also been expanding options for clients to have more direct say in how their shares are voted in the funds.
And BlackRock, they're the largest, right?
Yes, the world's largest asset manager. BlackRock positions investment stewardship as a really core function. They have dedicated teams for it. BIS, BlackRock Investment Stewardship, covers their index funds, and BIS handles the active side.
What are their main priorities?
They listed 5 benchmark engagement priorities in a January 2025 summary. Board quality comes first, then strategy and long-term resilience. Third is making sure executive pay incentives are aligned with creating financial value.
And the last two.
Notably, they call out climate and natural capital as a distinct 4th priority. And the 5th is company impacts on people thinking about workforce issues, human capital management.
So climate and social impacts are explicit pillars for them.
Yes, they frame them as distinct priorities alongside the traditional governance ones, and their engagement numbers are huge. Their 2024 summary reported over 3,300 engagements with almost 2,400 companies globally.
Talking to many companies multiple times.
Yeah, about 660 companies they engaged with more than once that year. They engage across all regions: Americas, Europe, Asia Pacific.
Any specific examples, like with Vanguard?
Sure. They mentioned engaging with NGSA, that same utility, covering board issues, strategy, pay, and climate risk. With ENISPA, the Italian energy giant, they noted 5 separate engagements covering a range of governance, social, and environmental topics, using internal codes to track them.
Interesting. And BlackRock's stance on climate engagement has also been evolving, hasn't it? There was some news about Climate Action 100 plus.
That's right. In early 2024, BlackRock announced that its main U.S. entity would be transferring its participation in the Climate Action 100 Plus initiative, which is a major global investor engagement group focused on climate change.
Why did they do that?
Their stated reasons were interesting. They said CA 100 Plus focus had shifted from primarily pushing for disclosure and governance around climate risk towards actively pushing signatories to commit client assets to strategies aimed at achieving net zero emissions across the whole economy.
And BlackRock felt that went too far for their main client base.
Essentially, yes. They argued that their primary duty for most clients is focused on maximizing financial returns, which includes considering material climate risks, but not necessarily committing all client assets to achieving a specific net zero outcome unless the client specifically mandates it.
But they have clients who do want that.
Yes, and they said that BlackRock International, which manages assets for clients who do have explicit net zero or decarbonization goals, would continue to engage in that more directive way, potentially still collaborating with initiatives like CA 100 Plus DAW. So it was a nuanced shift reflecting the diversity of their client base.
Okay, so we have these absolutely massive passive managers holding huge stakes across the market. This inevitably leads to a really big question, and you mentioned a major academic debate.
Exactly. Are these passive giants actually effective stewards of the companies they own, or are there reasons to think they might not be?
And some researchers, like Bebchuk and Hurst, have argued there are fundamental problems.
Yes, they've developed a theory around what they call agency costs, specific to index fund managers. They argue these managers face incentives that systematically lead them to underperform on stewardship.
What are those incentives?
They point to 2 main things. First, reasons to underinvest in stewardship activities. The core issue here is that if an index fund manager like Vanguard engages with the company and successfully improves its value, Vanguard itself only captures a tiny, tiny fraction of that benefit, maybe 0.1 or 0.2%, proportional to its fund's small fee.
But they bear all the costs of doing the engagement.
Exactly. They bear 100% of the costs, the staff time, the research, the travel. And because index funds primarily compete on having the absolute lowest fees, there's very little market pressure, maybe even negative pressure, on them to spend more money on stewardship, even if doing so would benefit the end investors in their funds. So the argument goes, they rationally underspend.
Makes sense economically was the second point.
The second point is they argue these managers have incentives for excessive deference to corporate management, basically being too willing to go along with what the company wants.
Why would they do that?
Several reasons. One is potential conflicts of interest. What if the company whose shares you hold is also a big client, maybe using your firm to manage its massive employee pension fund? You might be reluctant to push that company too hard on governance issues.
Okay, that's a clear conflict.
Another is fear of regulatory backlash. These firms are huge. If they become seen as too activist, too powerful in influencing corporate outcomes, they could attract unwelcome attention from regulators or politicians.
So they might keep a low profile.
Potentially. And then there are the direct regulatory costs and hurdles. For example, in the U.S., if you hold over 5% of a company and intend to influence its management or policies, you generally have to file a specific form, a Schedule 13D. This is a public declaration of intent, and it comes with extra requirements and potential scrutiny. Avoiding that hassle might lead them to be more passive, even when they hold large stakes.
So underinvestment and over-deference. Did Bebchuk and Hearst find evidence for this?
They pointed to quite a bit of empirical evidence from around the late 2010s. For instance, they highlighted the limited resources the Big Three dedicated to stewardship back then.
We talked about the staffing levels earlier.
Right. Combined, BlackRock, Vanguard, and SSGA had fewer than 80 people focused on stewardship globally, responsible for overseeing literally thousands of portfolio companies.
And the spending was low, too.
Very low. Estimated at less than 0.2% of the fee income they generated from the assets they managed. A tiny fraction.
And if you broke that down per company?
Even for companies where they held billions of dollars in shares, the estimated time and cost per company per year were minimal. Less than 4 person days of staff time for BlackRock, even less for the others, and under $5,000 in estimated cost per company annually. It suggests a very light touch, not deep engagement across the board.
What about actual engagement activity? Did they find much?
Looking at private engagements between 2017 and 2019, the data they cited showed that for a very high percentage of the companies in their portfolios, there was no recorded engagement from the Big Three during those years. Almost 90% for BlackRock and over 94% for Vanguard and SSGA.
So most companies weren't getting contacted at all.
According to that data, yes. Single meetings were infrequent, and multiple meetings with the same company were even rarer.
What about voting? That's a key tool, right?
It is. And their analysis of voting records from 2012 to 2018 suggested a pattern of siding with management. For example, the Big Three voted against executive pay proposals, the say-on-pay votes, far less often than active managers did.
Even when independent advisors recommended voting against.
Yes. Even when influential proxy advisory firms like ISS recommended voting against management on pay or other issues, the Big Three still voted with management a majority of the time. BlackRock went against ISS recommendations and supported management 17% of the time in those contested votes. Vanguard 27%, SSGA 37%.
What else did they point to?
They suggested the engagement often focused on basic, sort of check-the-box governance items rather than tackling deeper strategic or operational issues. And they found the Big Three rarely used their votes to oppose the re-election of directors, even at companies that were significantly underperforming their peers.
And did they use those more forceful tools from the escalation ladder we discussed, like nominating directors or filing proposals?
According to the research they cited for those periods, basically no. 0 director nominations by the Big Three between 2007 and 2018. 0 shareholder proposals filed by them between 2014 and 2018. Very limited involvement in commenting on regulations or participating in lawsuits against portfolio companies.
And that Schedule 13D filing, the one signaling intent to influence.
That was maybe the most striking finding. Despite holding over 5% stakes in thousands of U.S. companies, a level that typically triggers the 13D filing requirement if the investor intends to influence the company. Vanguard and SSGA filed exactly 0 13Ds between 2007 and 2018. BlackRock filed only 9 over that entire period.
So a strong signal they were actively avoiding being seen as activists.
That's the interpretation, yes. A reluctance to cross that line and publicly declare an intention to influence management or control.
Okay, so that's a pretty compelling case that passive managers might be, well, passive stewards. Does other research back this up?
Yes, there are other studies that seem to align with this view. One paper by Heath and others in 2022 found that increased index fund ownership was linked to boards becoming less independent and had 0 or even negative effects on other governance measures and the link between pay and performance.
And another one looked at company decisions.
Right. Schmidt and Fallenbrock in 2017 used a technique to try and isolate the effect of passive ownership increases. They found these increases were linked to things like lower stock price returns when companies announced mergers, suggesting poorer acquisition decisions, and an increased likelihood of the CEO also becoming the chairman of the board, which is often seen as weaker governance.
So the conclusion from these studies is,
Generally, that passive investors appear to be less effective monitors of corporate management compared to active investors, and that their rise might shift power away from shareholders and towards incumbent managers. Some even conclude that exit selling shares is still the preferred tool for index funds when possible, rather than voice.
hang on, you said it's a debate. There must be another side to this story. Evidence suggesting passive managers are effective.
Absolutely. There is research that comes to quite different conclusions. For instance, an earlier study by Appel and others, also trying to isolate the impact of passive ownership changes, found evidence suggesting that passive funds do exert governance influence, primarily through their large, coordinated voting blocks.
What kind of influence did they find?
They linked increases in passive ownership to subsequent improvements in corporate governance, such as boards becoming more independent, companies removing anti-takeover defenses that shareholders dislike, and moves towards more equal voting rights for all shareholders.
And did they link that to performance?
Yes, they found these governance improvements associated with passive ownership were then linked to better long-term firm performance and value. Now, there are limitations. The study didn't directly address ESG issues. The evidence is somewhat indirect, and findings might not apply to all types of companies, but it presents a counter-narrative.
What about environmental impact specifically?
Another interesting study by Izar and colleagues in 2021 focused specifically on the Big Three and environmental outcomes. They found that the Big Three do tend to concentrate their engagement efforts on the largest companies with the highest carbon emissions.
And did they find an effect?
They did. Their analysis found a negative association between the level of Big Three ownership in a company and its subsequent carbon emissions. Basically, higher Big Three ownership was linked to lower future emissions, and this relationship seemed to get stronger over time.
So, suggesting passive engagement can influence environmental practices.
That's the implication, yes. Again, there are methodological challenges the study relied on, publicly reported engagement data, which might not capture everything, and it establishes a causal link between contact and CO2 reduction, but it provides evidence supporting the idea that passive giants can be effective environmental stewards.
How did Bebchuk and Hurst respond to these counterarguments? Did they address these studies?
They published a rejoinder in 2022. They acknowledged the points, but doubled down on their core arguments. They emphasized the sheer, undeniable, and still growing power of the Big Three, pointing out their combined S&P 500 ownership had tripled between 2000 and 2021, reaching nearly 28% of voting power, and is projected to keep rising.
Did they mention that power paradox?
Yes, they highlighted what they see as this paradox, where the Big Three often publicly downplay their influence and emphasize deference to boards, while simultaneously telling clients and the public that their engagement is having a positive impact, especially on ESG. They also noted that corporate advisors who work with companies certainly perceive the Big Three as having immense power.
And they still believe the structural problems remain.
Correct. They argued that market mechanisms haven't solved the underinvestment and deference issues. They contend that much of the current ESG-related stewardship focuses more on encouraging companies to disclose information about ESG risks rather than pushing for fundamental changes in their actual operations to reduce those risks. And ultimately, they believe corporate managers remain largely insulated from meaningful challenge by these passive giants.
So the debate really does continue. It sounds like a fundamental disagreement about how powerful and effective these huge investors really are.
It is, and a big part of why it's so hard to get a definitive answer is because of a major challenge in this kind of research, something called endogeneity.
Endogeneity. Okay, what does that mean in this context?
It's basically the chicken and egg problem. It's really hard to know for sure if increased passive ownership causes a certain change in a company, like better governance or lower emissions, or if companies that were already improving their governance or emissions maybe became more attractive to passive funds, or maybe some other underlying factor we haven't measured is influencing both the level of passive ownership and the company outcome.
So correlation doesn't equal causation.
Exactly. Passive ownership levels and company outcomes might be influencing each other, or both driven by something else entirely. Things like omitted variables, factors we didn't account for, or reverse causality. Maybe the outcome caused the ownership change, not the other way around. make it really tricky to draw firm causal conclusions just by looking at correlations.
So how do researchers try to overcome this? You mentioned some studies use specific techniques.
Right. One popular approach is to try and find natural experiment situations where something changes passive ownership levels for reasons that are arguably unrelated to the company's own characteristics or performance.
Like what?
A classic example used in many studies involves the annual reconstitution of stock market indexes, particularly the Russell 1000 and Russell 2000 indexes in the U.S.
How does that work?
So every year, Russell ranks U.S. companies by market capitalization, their total stock market value. There's a threshold around rank 1000. Companies just above the threshold go into the Russell 1000 index, larger companies, and those just below go into the Russell 2000 index, smaller companies.
And companies can move across that line year to year.
Yes. A company that was, say, rank 1005 one year might grow slightly and become rank 995 the next year. If it crosses that threshold from the 2000 into the 1000 index, suddenly all the passive index funds that track the Russell 1000 have to buy its stock, and funds tracking the Russell 2000 have to sell it.
So it gets a sudden, significant change in demand from passive investors just because it crossed an arbitrary ranking line.
That's the idea. It experiences a big shock to its level of passive ownership that isn't directly driven by its own recent performance or decisions, but rather by its relative ranking around this cutoff point. Researchers trying to use this arguably random or exogenous shock to isolate the causal effect of that change in passive ownership on subsequent company behavior or outcomes.
Sounds like a clever way to try and untangle cause and effect. But is it foolproof?
Well, like many clever ideas, it's come under scrutiny. More recent research has raised some serious questions about whether this Russell Index reconstitution is truly a clean, natural experiment.
What are the problems?
Several issues have been pointed out. There are technical identification issues, for example. Russell introduced a policy in 2007 to create bands around the cutoff to reduce turnover, which makes the movement less random than assumed. Also, firms very close to the threshold might actually be systematically different from firms further away, even within the same index. And there's even some evidence that companies might try to subtly manage their market cap around the cutoff date to influence which index they land in.
So, not perfectly random. Any other critiques?
Yes, there are technical challenges too. Studies show that the results you get from this method can be very sensitive to exactly how you define the comparison groups, which control variables you include in the analysis, how wide a bandwidth you look at around the cutoff, and how you weight the observations. Different choices can lead to different conclusions.
Tricky. Anything else?
There are also potentially confounding factors. Sometimes the change in a stock's weighting within an index, even if it stays in the same index, can have a bigger impact on passive fund buying or selling than switching indexes entirely. Also, the reconstitution dates are known in advance, so sophisticated traders might anticipate the changes, blurring the picture. And it's not just passive funds reacting. Other investors might also change their behavior around these events.
And do findings from these mid-sized companies around the Russell threshold necessarily apply to giant companies or very small ones?
That's the generalizability concern. The effects observed for these specific firms hovering around the 10th rank might not be representative of how passive ownership affects all companies across the market spectrum. The impact might be strongest only in the short term, right after the reconstitution.
So even the natural experiment approach isn't a silver bullet.
It seems not. As one critical review put it, the findings highlight the sensitivity of results to methodological choices and underscore the importance of very careful research design when trying to measure these effects. It's just inherently difficult.
Okay, so measuring the impact of the big three passive managers is complex.
Yeah.
What if we look at an even larger type of owner? Someone who owns such a massive slice of the entire global market that they almost have to engage because selling isn't really feasible.
That's a great point. Let's consider a prime example. The Government Pension Investment Fund of Japan, known as GPIF.
GPIF, how big are they?
They are, or at least were in 2021, the world's largest pension fund. We're talking assets around 1.7 trillion US dollars back then. Because they manage pensions for Japanese citizens with a very long time horizon, they're considered a classic universal owner.
Meaning they own a little bit of almost everything.
Pretty much. They have exposure to thousands of companies globally. Their goal is the long-term health and return of the entire market. And importantly for our discussion, GPIF outsources all of its actual asset management and engagement activities to external fund management firms.
And how much of that $1.7 trillion is invested passively?
A A huge proportion. As of the end of fiscal year 2021, over 85% of their total assets were managed passively, just tracking various market indexes across domestic and foreign bonds and equities. Active management was less than 15%.
So mostly passive. Why did they become such a big proponent of ESG engagement?
A key motivation came around 2018-2019 when data showed that Japanese companies, on average, were lagging behind their peers in other major developed countries like France or the UK when it came to ESG performance scores from major rating agencies like FTSE and MSCI.
So they saw a need to push Japanese companies to improve.
Exactly. Their official stewardship policy, revised in 2020, explicitly focuses on preventing activities by companies that could hurt the long-term growth of those companies and the overall capital market, which is crucial for securing those pension returns over decades.
How do they implement this if they outsource everything?
Their approach has several parts. They became a signatory to the UN Principles for Responsible Investment, PRI, back in 2015. A big part of their strategy is incorporating ESG by investing heavily in specific ESG-themed indexes, including best-in-class ESG indexes since 2017.
And the engagement part.
Under their active ownership principle, they require their external managers to engage. They monitor how these managers are doing, and significantly, since 2018, they've been paying two of their external asset managers an extra fee specifically to conduct engagement focused on improving the ESG performance of the Japanese companies in GPIF's portfolio. One of these managers is AM1.
Do they also vote their shares based on ESG?
Yes, their proxy voting guidelines include ESG considerations, and they monitor how their managers vote. But one important point is that GPIF generally does not use categorical exclusions. They don't just refuse to invest in entire sectors like tobacco, controversial weapons, or fossil fuels, which some other large funds do. Their approach is more focused on engagement and using ESG indexes.
Okay, so this extra paid engagement by managers like AM1 seems like a key initiative. Has anyone studied if it's actually working?
Yes, a study by Becht and colleagues published in 2023 looked specifically at the impact of AM1's engagement efforts on behalf of GPIF between April 2018 and March 2022.
How do they try to measure the impact?
They used a conceptual model. They looked at a company's initial ESG score before engagement, tracked the engagement process using milestones reported by AM1, and then looked at the company's subsequent ESG scores afterwards, comparing engaged companies to similar ones that weren't engaged.
And which ESG scores did they use? You mentioned FTSE and MSCI earlier.
They used both FTSE Russell and MSCI ESG ratings, which are two of the most widely used providers. And it's really important to understand that these systems work quite differently.
How so?
FTSE Russell uses over 300 indicators across environmental, social, and governance pillars, scoring companies from 0 to 5. A key feature is how they handle disclosure. If a company doesn't disclose data on a specific indicator, FTSE generally assigns a score of 0 for that indicator. So simply starting to disclose more information can directly improve a company's FTSE score.
Okay, disclosure equals points on FTSE. What about MSCI?
MSCI identifies key E, S, and G issues that are considered most material, both universally and for specific industries like carbon emissions and water stress being key for a soft drink company, while labor management and product safety might also be crucial. Unlike FTSE, if a company doesn't disclose data, MSCI typically treats it as a missing value, not necessarily a 0 score.
Any other big differences?
A really important one is materiality weighting. MSCI dynamically adjusts the importance or weight it gives to different ESG issues based on its assessment of their financial relevance to that industry and company over time. This can lead to some counterintuitive results, as we'll see.
Okay, two different rating systems. What about AM1's engagement process itself?
AM1 engaged companies on about 20 specific ESG issues, things like climate change strategy, diversity policies, board independence, etc. They track their progress using 8 internal engagement milestones.
What are those milestones?
They range from step 1, simply identifying the issue, to step 3, the company recognizing the issue, step 4, senior management recognizing it, step 6, the company formulating plans, step 7, implementing plans, and finally, step 8, completing the engagement. Reporting progress on these milestones was actually a key performance indicator, KPI, for AM1 under its contract with GPI.
How much engagement did AM1 actually do?
Over that 4-year period, they engaged with 571 different Japanese companies, initiating 622 specific milestone engagements. They had nearly 3,800 contacts, meetings, calls, letters in total.
Where's the focus? Governance, environment, Social.
Governance topics accounted for the largest share of contacts, about 1,600. Environmental topics had around 480 contacts, and social about 250.
And how far do they get on those milestones? Do they reach implementation often?
According to AM1 self-reporting, about a third, 33.1% of their engagements reached at least milestone 4, where senior management acknowledged the issue. However, only a very small fraction, just 2.1%, reached the final milestone 8, completing engagement within that time frame.
Okay, so lots of contact, some progress in getting issues recognized, but maybe less evidence of full implementation yet. What happened to the ESG scores? Did the engagement make a difference?
This is where it gets really interesting. Using statistical methods called difference in differences, DD, to compare engaged companies with similar non-engaged ones. When they looked at the FTSE ESG scores, the results were pretty positive.
What did they find?
They found that the companies engaged by AM1 showed a more pronounced upward trend in their FTSE scores after the engagement started in 2018 compared to the control group. The study found statistically significant positive impacts on the overall FTSE ESG score, on the environmental score, specifically following environmental engagement, and on the overall score following general ESG-themed engagement.
But not for social or governance engagement specifically.
Interestingly, using the D method on the FTSE scores, they didn't find a significant positive impact on the social pillar score from S engagement or the governance pillar score from G engagement.
Okay, so positive results for FTSE overall, especially E. What about the MSCI scores?
Much less divergence. The scores of engaged and never engaged companies didn't separate as clearly over time using the MSCI ratings. The only statistically significant positive impact they found was on the governance score, specifically following governance engagement. No significant impact on overall MSCI score or E or S scores from related engagement.
Wow, so the same engagement activity seems to have a significant impact on FTSE scores, but much less on MSCI scores. Why the difference?
The study explored several reasons for this divergence. One factor was specific issues. For example, AMA1 engaged companies on removing anti-takeover protections. MSCI includes this in its governance score, while FTSE generally doesn't. So success there would boost the MSCIG score, but not FTSE.
And that disclosure difference.
That seemed crucial. Because FTSE penalizes non-disclosure with a 0 score, engagement that simply convinces a company to start reporting data on, say, environmental metrics can directly improve its FTSE E-score, even if its actual environmental performance hasn't changed yet. MSCI, by treating non-disclosure as missing data, wouldn't necessarily show that same score improvement just from disclosure.
So engagement might be driving disclosure, which FTSE rewards more directly.
That appears to be a major factor, yes. Another issue was theme mapping. If AM1 engaged heavily on a theme that happened to have a low weight in the rating agency's scoring for that particular company or industry, it wouldn't move the overall score much, even if the engagement was successful on that specific theme.
And you mentioned something about MSCI's weights changing, the MSCI paradox.
Right. This is a fascinating aspect of MSCI's methodology. Because their materiality weights are dynamic, if a company significantly improves its management of a particular ESG risk, say water stress, MSCI might actually lower the materiality weight assigned to water stress for that company in the future, arguing it's now less of a risk.
So improving on an issue could lead to that issue becoming less important in the overall score calculation.
Potentially, yes. This could offset the score gains achieved on that specific issue when calculating the overall ESG rating. The study used an example of a Japanese retail company, S1E5 Holdings. Its FTSE score increased after engagement. Its underlying MSCI environmental indicator scores also improved, but MSCI simultaneously decreased the weight of the environment pillar in its overall rating for the company, which largely offset the gains, resulting in little change to the overall MSCI ESG rating.
That's complex. So the rating system itself can influence the measured outcome of engagement.
Hugely. It really highlights how dependent our assessment of engagement success can be on the specific measurement tool we use, especially for broad concepts like ESG.
Did GPIF itself evaluate this program?
Yes, GPIF published its own broader evaluation project, results in May 2024, covering nearly 27,000 engagements conducted by all 21 of its external asset managers between 2017 and 2022.
What did they find overall?
They noted the most frequent engagement themes were things like board structure, management strategy, and climate change. They referenced the Becht et al. Study we just discussed, acknowledging his findings that engagement, particularly by the dedicated managers like AM1, did correlate with improvements in ESG scores, especially FTSE environmental scores. They also found some evidence linking inclusion in ESG indexes to positive stock price movements.
But was it a glowing report card overall?
Not entirely. Despite the high volume of engagement activity across all managers, the GPIF's own report described the overall results regarding improvements in overall ESG scores as somewhat disappointing. So while targeted efforts seemed to work, the broader impact across all managers was perhaps less than hoped for.
Okay, so even for a massive, motivated owner like GPIF, driving and measuring ESG improvements through outsourced engagement is challenging, and the results depend heavily on which yardstick you use. Let's switch gears now. What about active managers, the ones who can sell shares easily? How does their engagement work?
Right, this brings us to another fascinating area. A different study, also involving Marco Becht along with Julian Franks and Hannes Wagner, looked deeply into the private meetings held between a large UK-based active asset manager, Standard Life Investments, SLI, and the companies in its portfolio. This was using data from 2007 to 2015.
And this research connects different fields of study you mentioned.
Exactly. It bridges two often separate lines of thinking. On one side, you have the active ownership literature, often coming out of Europe and the UK, which tends to view engagement positively as a tool for stewardship, improving companies, and promoting ESG outcomes.
And the other side?
The other side is the literature on fund manager analyst meetings, which is often more US-centric and heavily influenced by regulations like Regulation FD, fair disclosure. This perspective tends to be more skeptical, often focusing on whether these private meetings allow sophisticated investors to gain an unfair informational edge or even trade on material non-public information, MNPI.
So, different starting points, partly due to different regulations.
Very much so. The regulatory environments in the UK and US regarding information disclosure were quite different, especially during the period studied.
How did the UK system work?
The UK operates under a principle often called parity of information. Essentially, trading on MNPI is broadly legal for everyone, not just traditional insiders. If a company needs to share MNPI with an investor in a private meeting, it requires a formal process called wall crossing, where the investor acknowledges receipt of MNPI and agrees to a trading blackout period until the information becomes public.
So the expectation is prompt public disclosure.
Yes, companies are generally expected to disclose material information to the whole market promptly. General business discussions and private meetings are allowed, provided no MNPI is selectively disclosed. The UK's definition of insider trading was considered broader and potentially stricter than the US, highlighted by cases like the one involving David Einhorn.
And how does that contrast with the US Reg FD?
Reg FD in the U.S. prohibits companies from selectively disclosing MNPI to certain parties like analysts or large investors. However, it doesn't outright ban private meetings. And, crucially, a violation of Reg FD by the company isn't automatically considered an insider trading violation by the investor who received the information.
So potentially more gray areas in the US.
That's how many scholars see it. Some U.S. legal experts, like Professor John C. Coffey, have argued against adopting a strict UK-style parity system, fearing it would chill legitimate information gathering by analysts and fund managers, making markets less efficient. He famously described U.S. insider trading laws having gaps and loopholes the size of the Washington Square Arch.
Okay, so SLI was operating under that stricter UK parity system. What did this study look at?
They looked at SLI's internal structure. Portfolio companies interacted with different people at SLI. The governance specialists focused on ESG and board issues, the sector analysts focused on industry and company financials, and the fund managers making the final buy-sell decisions. Information flowed between these groups. The researchers had access to thousands of internal notes from meetings held by both fund managers and governance specialists.
What kind of things were discussed in these meetings? Did they differ?
Yes, significantly. Using text analysis, like word clouds, they found fund manager meeting notes were heavily dominated by words like growth, strategy, performance, outlook, margin, cash flow, classic financial and operational topics.
And the governance specialist meetings.
Their notes featured words like remuneration, board composition, corporate governance, shareholders, but also environmental, social, and ethical. Much more focused on governance and ESG, though clearly overlapping with business issues.
And the key point under UK rules is that if SLI was trading shares after these meetings without being formally wall-crossed, this information shouldn't have been considered MNPI, right?
Correct. It should have been information obtainable through diligent analysis or general discussion, not secret, price-sensitive facts. Interestingly, though, a separate U.S. survey from 2022 found that professional investors rated firm strategy and vision as the most influential type of information they get from private meetings, while ESG activities were rated the least influential.
So maybe the financial stuff discussed in FM meetings was perceived as more valuable for trading.
Hmm.
Did the SLI study find a link between meetings and actual trading?
Yes, they did. Using regression analysis, they found that fund manager meetings were statistically linked to an increased magnitude of trading, either buying or selling, shortly after the meeting, and specifically to a higher probability of making a buy trade within 0 to 5 days.
What about the governance specialist meetings?
Those meetings were also positively linked to the probability of a buy trade. The link to overall trade magnitude or selling probability was a bit more mixed, depending on the exact analysis, but there was definitely a connection between these governance-focused meetings and subsequent trading.
Can you give an example of how this might play out?
The study highlights the case of Carillion Palak, a large UK construction and services company that famously collapsed into liquidation in early 2018. SLI was a significant shareholder.
What happened?
In December 2015, about 2 years before the collapse, an SLI governance specialist met with Carillion's chairman. The internal notes from that meeting contained some really interesting, soft information, subjective observations.
Like what?
The notes describe the chairman as being on chipper form, unfeasibly tanned, having a light touch approach, and that the overall situation regarding some overseas contracts sounded rather confusing.
That's not hard data, is it? More like impressions.
Exactly. It's subjective assessment of management's demeanor, grasp of detail, clarity. But this kind of soft information can be incredibly valuable. Just 2 weeks after that meeting, SLI's internal sector analyst, likely incorporating insights from the governance team, changed their recommendation on Carillion stock from hold to sell.
And the company went bankrupt later.
Yes, about 6 months after that downgrade, though the final collapse was later. It's a powerful illustration of how insights gained even from a governance-focused meeting, assessing management quality, sensing confusion, or lack of grip, could provide crucial, timely signals about underlying problems. This could inform a valuable trading decision selling before the crash.
A decision that passive index trackers holding Carillion couldn't easily make.
Precisely. They were largely stuck holding it as it went down because it was in the index. This highlights the potential value active managers can derive from engagement, including gathering that soft information.
Did the study try to quantify this soft versus hard information using newer tools?
Yes, they used large language models, specifically GPT-4, to analyze the text of the meeting notes and classify sentences as containing either hard information, like verifiable facts, numbers, or soft information, subjective opinions, assessments of people, tone.
What did they find?
They found that fund manager notes contained a significant amount of soft information, around 62%, mostly about the firm itself. Governance specialist notes contained even more soft information, about 77%, again, mostly focused on the firm and its management.
Did the type of information link to trading?
The LLM analysis suggested it did. Fund manager meetings with a high proportion of soft information seem to be linked to an increased probability of selling shares afterwards. Governance specialist meetings with high soft info were also linked to selling, while high hard info in GS meetings was actually linked to decreased selling.
That's interesting. Soft information predicting selling.
It suggests that maybe those subjective assessments of management or strategy were often picking up negative signals. The LLM was also used to try and identify potential instances where MNPI might have been discussed, mentions of next-day earnings, M&A activity, CEO changes.
And did they see trading around those potential MNPI discussions?
They looked at trading patterns in the days surrounding meetings where the LLM flagged potential MNPI discussion. There was some indication of increased trading activity, particularly a spike around 4 days after the meeting. This might suggest that if MNPI was discussed, trading perhaps occurred later, possibly after the information became public or formal wall-crossing procedures were followed, consistent with the UK rules.
Did the LLM look at the intensity of engagement? Like, was SLI pushing its views?
Yes. They used the LLM to count how often the notes reflected the investor, SLI, expressing views or making demands versus just listening to the company. They found that governance specialist meetings frequently involved SLI actively asserting its views, phrases like, "we assert," "we voiced our concerns." Fund manager meetings also involved expressing views like, "we left them with the message, we urged them," so it wasn't just passive listening.
So the bottom line, did these meetings seem to lead to profitable trades for SLI?
The study looked at the performance of hypothetical portfolios formed by buying or selling stocks on the days SLI had meetings with those companies. The results were quite striking.
What did they show?
Portfolios based on trades made on fund manager meeting days showed the highest subsequent returns, outperforming the market by about 3.5% over the following 40 trading days. Portfolios based on governance specialist meeting days also outperformed, generating about 1.2% excess return over the same period. Both significantly outperformed days with no meetings, which showed only about 0.5% excess return.
So strong evidence of informed trading a link to these private meetings.
It strongly suggests that yes, particularly for the fund manager meetings, but also for the governance specialist meetings. It indicates that active managers, operating under the UK's parity of information system, were indeed gaining valuable insights from these private engagements, insights that translated into profitable investment decisions.
What's the main takeaway from this active manager study then?
I think the core conclusion is that active managers do appear to gain valuable information, including crucial soft information for assessing management and boards, through private engagement, even within a regulatory system designed to prevent informational advantages. This suggests there are real financial incentives for active managers to monitor, understand, and engage with the companies they own.
And ESG engagement isn't just fluff.
Apparently not. The study showed that the governance specialist meetings, which heavily featured ESG topics, were also associated with informed trading and positive returns. This suggests ESG engagement provides information that is valuable for investment decisions, not separate from them.
And the implications for recognition.
The findings suggest that the UK's parity system, while aiming for fairness, didn't seem to completely chill the valuable information gathering process by active managers. It implies that proposals sometimes debated in the U.S. context, like requiring all investor meetings to be webcast or even banning them altogether to enforce Reg FD, could potentially undermine legitimate and valuable engagement activities that contribute to market efficiency and informed stewardship.
Okay, that's a lot to take in.
Yeah.
Let's try to connect all these threads from our deep dive today.
Sure. We've seen that shareholder engagement isn't just one thing. It's often an escalating process, from quiet dialogue up to divestment.
And the players involved, passive managers, activists, have very different tools, resources, and crucially different incentives shaping how they engage, right?
Exactly. Passive giants, like the Big Three, face structural challenges and incentives that might limit their stewardship, leading to that ongoing debate about their effectiveness, which is further complicated by the difficulties in actually measuring their impact causally.
While huge long-term universal owners like GPIF can try to shape the whole system by mandating engagement, but even then, success is hard to quantify and depends heavily on which ESG rating agency's yardstick you use.
Right. And then you have the active managers, like SLI in the UK study, who clearly seem to gain valuable information, both hard and soft, from their private engagement activities, including ESG discussions.
And that information feeds directly into their investment decisions, showing a tangible link between stewardship and trading, all influenced by the specific regulatory environment they operate in.
It really paints a complex picture. The effectiveness debate around passive managers is real and ongoing. The divergence in ESG ratings adds another layer of complexity. And it highlights that even seemingly intangible soft information, assessing management, sensing confusion, can be absolutely critical for understanding companies and risks.
It's a fascinating, complex, and definitely evolving picture of how those who own a piece of a company try to ensure it's being run well for the long term.
It really is. The relationship between owners and companies is constantly being reshaped by these forces.
So here's something for you, our listener, to think about. Given the differing incentives and strategies we've discussed today, how might the continued rise of passive investing fundamentally change the relationship between companies and their owners in the decades to come? Thanks for joining us today. Until next time, keep exploring.